XACT Nordic High Dividend Low-Volatility ETF, launched in 2017, is managed by XACT Capital Management, a subsidiary of the Handelsbanken Group. The fund is domiciled in Sweden and primarily listed on the Stockholm Stock Exchange. The core investment philosophy of XACT Nordic is rooted in smart beta principles, which depart from traditional market capitalization-weighted strategies to target specific risk factors that have historically provided superior risk-adjusted returns. The fund's objective is to replicate the performance of the Handelsbanken Nordic High Dividend Low Volatility Criteria Index, which provides exposure to a curated selection of approximately 45 to 50 Nordic companies. This index is constructed using a multi-factor ranking system that prioritizes companies exhibiting the highest dividend yields and the lowest historical price volatility. The methodology begins with a broad universe of the most liquid equities listed on the stock exchanges of Sweden, Norway, Denmark, and Finland. The inclusion of a liquidity screen is a critical risk mitigation step, ensuring that the ETF can handle significant inflows and outflows without causing excessive market impact. Following this initial screen, companies are ranked based on their realized dividend yield over the preceding 12 months and their historical volatility, typically measured as the standard deviation of daily returns over a specific look-back period. The final portfolio is optimized to maximize these two factors, while maintaining sectoral and geographic constraints to avoid extreme concentration. As of the first quarter of 2026, the fund's size and scale facilitate high liquidity and tight bid-ask spreads. The ongoing charge of 30 basis points, 0.30%, positions XACT Nordic as a cost-efficient vehicle. The use of optimized physical replication, where the fund holds the underlying stocks directly, reduces counterparty risk compared to synthetic ETFs that use derivatives to track their benchmark. The XACT Nordic portfolio is characterized by a significant tilt toward large and mid-cap value stocks, with a heavy concentration in sectors that are traditionally seen as stable dividend payers. The low volatility filter naturally steers the fund away from high beta sectors like technology and biotechnology, favoring instead the utilities, financial services, and consumer staples industries. The sectoral allocation of XACT Nordic is a direct consequence of its dual-factor mandate. As of the current reporting period, the financial services sector represents the largest weighting, a common feature of high-dividend Nordic strategies due to the profitability and capital strength of the region's banking institutions.
The high exposure to financial services, 38.10%, is notable, as it is nearly 14 percentage points higher than the category average. This reflects the high-yield environment of Nordic banks like Swedbank and DNB, which have historically maintained strong payout ratios. Conversely, the fund's zero exposure to energy and real estate suggests that these sectors either did not meet the low volatility requirements or were excluded due to the index's sustainability criteria. The significant underweight in healthcare, 2.89% versus 12.78% category average, is also striking, likely due to the higher volatility and growth-oriented valuation of many pharmaceutical and medical technology companies in the region. Although the fund is managed by a Swedish firm and traded in SEK, it provides diversified exposure across the four major Nordic economies. This geographic mix acts as a buffer against idiosyncratic risks in any single nation's economy. Sweden's majority weight, 50.14%, is consistent with its status as the region's largest and most liquid market. Norway and Finland are almost equally weighted, 19.7%, providing exposure to both the industrial strength of Finland and the bank-led income stability of Norway. The lower weighting of Denmark, 10.45%, is indicative of the Danish market's recent performance struggles and the exclusion of high-volatility pharmaceutical giants that dominate its domestic index.
The top holdings of XACT Nordic are representative of the fund's commitment to quality and stability. These companies are generally market leaders in their respective fields with resilient business models. The presence of telecommunications giants like Telenor, Tele2, and Telia, all with double-digit returns in the past year, highlights the fund's success in capturing income from stable, utility-like equity segments. Swedbank's exceptional one-year return of 56.64% has been a significant contributor to the fund's recent outperformance, illustrating the value of high-dividend financial stocks in a rising or stable interest rate environment. XACT Nordic's historical performance must be evaluated through the lens of its dual-factor strategy. Historically, low volatility and high dividend stocks tend to outperform during periods of market stress or consolidation, but may lag during aggressive risk-on bull markets, dominated by growth and technology stocks.
As of April 2026, the fund has demonstrated significant outperformance relative to its category and benchmark index over several time horizons. This suggests that the low volatility filter has been effective in screening out the more volatile elements of the Nordic market that suffered during the geopolitical shocks of 2024-2025. The annualized 3-year return of 13.53% is particularly impressive when compared to the benchmark's 4.81%, indicating a substantial alpha generation from the fund's factor tilts. The performance in 2025 was a standout year, where the fund achieved a return of 21.34%, vastly outperforming the category average of 5.28%. This outperformance was likely driven by the strength of the Swedish banking sector and a flight to safety in the wake of trade tensions and Middle Eastern conflict volatility. The primary appeal of XACT Nordic is its ability to provide these returns with lower realized volatility. Over a 3-year trailing period, the fund has maintained a significantly better risk profile than its peers. A beta of 0.46 indicates that XACT Nordic is less than half as sensitive to broad market movements as the overall index, a remarkable feat for a long-only equity fund. The Sharpe ratio of 1.29, which measures excess return per unit of risk, is vastly superior to the index's 0.15, confirming that the fund has provided excellent risk-adjusted compensation for investors. The maximum drawdown of only -4.22% versus nearly -20% for the index highlights the low volatility filter's efficacy in capital preservation.
For many investors, the primary motivation for holding the ETF is its quarterly dividend distribution. The fund management has a target policy of distributing 4.5% of the fund's NAV annually, although the actual payout is determined by the dividends received from the underlying holdings. The dividend history shows a trend of consistent growth, interrupted only by the unique circumstances of the global pandemic in 2020-2021. The fund's yield has historically fluctuated between 4.0% and 5.8%, positioning it as a significant income generator. The 2025 growth of 8.72% in dividends reflects the strong earnings recovery and increased payout ratios of Nordic financials and industrials. As of April 2026, the forward dividend yield is 4.55%, providing a substantial premium over the Morningstar Nordic Index yield of 3.33%. Dividends are distributed 4 times a year. The typical months for distribution are March, May, September, and November. This quarterly schedule is a competitive advantage in the Nordic market, where many local funds only distribute annually, often in the second quarter following the annual general meetings.
Despite its conservative positioning, the ETF is subject to several significant risks that could adversely affect its NAV and dividend-paying capacity. The most prominent risk is the fund's heavy concentration in the financial services sector, 38.10%. While the Nordic banking sector is highly capitalized and currently very profitable, Nordea reported a 15.4% ROE in Q1 2026, it remains sensitive to regional economic cycles. A significant downturn in the Swedish or Norwegian housing market could lead to a spike in loan losses, forcing banks to cut their dividends. Given that nearly 40% of the fund's income and valuation is tied to these institutions, the impact would be systemic for the ETF. High dividend stocks are often viewed as bond proxies. When interest rates rise, the relative appeal of a 4.5% dividend yield diminishes compared to government bonds. Furthermore, if inflation remains above 2%, the real inflation-adjusted return of the ETF's distributions would decline. While the 2026 outlook projects stable rates, any unexpected inflation shock would likely lead to a strong sell technical signal as the factor regime shifts.
There is a structural risk that the value and low volatility factors may go through extended periods of underperformance. In a market dominated by high beta growth themes like artificial intelligence or biotechnology, the ETF is almost certain to trail the broader indices. For example, in 2023, the fund's return of 8.77% was nearly 8 percentage points behind the Morningstar Nordic Index, 16.71%, as that year was characterized by a surge in growth-oriented tech stocks. While XACT Nordic is a large ETF with an AUM of 18.58 billion Swedish kroners, it invests in mid-cap stocks, 56.39% of the portfolio, that may have lower liquidity than the giant caps that dominate standard indices. In a period of severe market stress, the bid-ask spreads for these mid-cap holdings can widen, which in turn causes the ETF's own spread to widen or its price to trade at a significant discount to NAV. Evaluating XACT Nordic on a fundamental basis reveals a portfolio that is significantly cheaper than the broader market, as would be expected from a value-tilted factor strategy. Comparing the ETF to its category average and the broad Nordic index highlights its valuation margin of safety.
With a PE of 13.99, the fund is trading at a discount of approximately 5% relative to the Morningstar Nordic Index, 14.71. The price-cash flow ratio of 10.79 is also notably lower than the index's 11.67, suggesting that the fund's constituents are more efficient at generating cash relative to their market price, a key prerequisite for sustainable dividend payouts. Despite the value focus, the fund's constituents exhibit reasonable growth profiles, although they lag behind the broader index in long-term earnings projections. The historical earnings growth of 2.97% is significantly higher than the index's 0.74%, indicating that the quality screens within the smart beta methodology have successfully selected companies with more resilient profit trajectories during recent economic downturns. However, the lower sales growth, 1.03% versus 2.17%, and book value growth, 3.05% versus 4.70%, reflect the mature, cash cow nature of the companies in the portfolio. These firms prioritize distributing capital over reinvesting it for high-velocity growth.
Conclusion. The fund's primary strengths lie in its risk-adjusted returns, characterized by an exceptionally low beta, 0.46, and a high Sharpe ratio, 1.29. The consistency of its dividend payouts, even during volatile macroeconomic periods, makes it an ideal instrument for income-oriented portfolios. The main vulnerability is heavy concentration in the financial services sector and its exposure to the Swedish economy, which faces structural headwinds from high household debt. Additionally, the fund is inherently sensitive to global trade policy. Any significant escalation in international tariffs would disproportionately affect its industrial holdings. Finally, the fund will inevitably lag during risk-on bull markets, where high-growth, low-dividend sectors lead the way.